Meghan, it's great to have you. Sometimes they say flat is a position. It kind of sounds like that's where you are today.
Yeah, Carl, thanks so much for having me. I think, I don't know about flat being a position. We do still have an overweight to equities and portfolios. Patience is definitely a position that we think is warranted right now. It rarely is fruitful in the long run to sell in a panicked market. And I really do think that's what we're faced with. There's just so much uncertainty. It's geopolitical in nature, which clearly is difficult for investors to model and price accordingly. I think this is a very serious political event, and it has some spillover implications for investors. But as of right now, we expect a somewhat modest economic impact, economic spillover. So a fairly modest adjustment downward for areas that are most closely associated with the conflict that's unfolding, so namely Europe. And probably the biggest risk to the U.S. consumer would be if oil prices escalate further and stay elevated for a prolonged period of time, where clearly sentiment has already deteriorated because of inflationary concerns.
Right. Why, for those who are more worried about commodity disruption, less energy security all around the world, this whole situation inflating stagflationary fears, why aren't you worried about that, or as worried about that?
Well, we're concerned. I would say upside risks to inflation is one of our biggest risks that we're monitoring. We still have an expectation, at least in the U.S., that growth is going to remain very solid. We have a 3% GDP forecast for 2022. So while it's certainly slower than 2021, that's not a stagflationary backdrop. Again, the oil price transmission mechanism is probably the biggest risk, but so far it's the price of oil is trading on fear of disruptions. We have not seen any supply disruptions. We don't anticipate that as our base case. It would hurt everyone, including not only Russia, but Europe, the US. So I think policymakers are going to be very careful about using that as a sanction tool in this environment. And so if we don't see that, we do think that oil prices could moderate. And again, if our economic backdrop comes to fruition, that's not a stagflationary environment.
Right, but Meghan, it's hard to, at this moment, judge how much sort of pain Western economies are willing to self-inflict to hurt Russia. So as we get prepared to hear more sanctions, is there something that would make you change your near-term thesis, such as export controls on semis or the commodities disruption that you've been talking about, or perhaps banning Russia from SWIFT?
Yeah, well, I think that the some of those more dramatic sanctions would probably have more they would be more in terms of spillover to Europe. And I think that is a possibility. Again, we've heard that Europe has opposed so far taking some of those steps and endorsing those. I think the Biden administration will similarly be hesitant to do anything that could jeopardize the energy supply. But there is a lot of unknown right now. Again, I think when you see volatility spike like this, outside of a global economic slowdown or a recession, which is still not our base case, even under the more dire scenario that's unfolding, we think it is more likely than not that we'll see equities trade higher over the next 12 months. And I think that there's other conditions to be thinking about in terms of the energy markets as well, with the possibility of Iranian supply coming on, maybe at the margin, some relief on prices from release of strategic petroleum reserves. So there's just too much uncertainty right now. So all we can do is stick to what we do know and what is unfolding. And again, we just are avoiding at this moment. It could change. It's changing by the hour, really. But at this moment, we are not selling our risk positions.